Brianna Gibson, and I will be presenting my analysis of the yield curve for the week of March 18th to March 22nd, 2013, and forecasting one-year interest rates out for the next 16 years. So this is my snapshot of the net change from Monday to Friday. It was a pretty eventful week. We start to see some change in yield curve actually at pretty low maturity, and a more drastic and obvious change toward the longer end of the yield curve. The entire yield curve happened to fall. These are my highlights for the week. On securities farther from maturity, decreased more than those closer to maturity. The curve flattened slightly over the course of the week. The average percentage change in rates over the period was a decrease of 2.31%. And when I say average percentage change, I mean I took the rate from Monday and the rate from Wednesday, and I calculated a percentage change between the two numbers. I did that for the rates on Treasury securities at all maturities, and took the average change on all those maturities to come up with this figure, 2.01%. This volatility in treasury rates can be explained in major part by the Federal Reserve press release and the Cyprus bailout. Investors chose to put their money into less risky investments in response to uncertainty brought on by the Cyprus financial crisis, pulling the treasury rates down. This is my forecast for the week and how it changed. The line at the top was my forecast on Monday, and at the bottom is my forecast on Friday. And there are some pretty noticeable changes in the forecast around this time, which is the 5-year, this time, which is about the 10-year, and further out around 15 years. Okay. So the decrease in the yield curve rates means the lower forecasted one-year rates using the expectations hypothesis theory. The net effect on expectations of one-year rates was a decrease on average of 2%. This forecast projects that one-year rates will rise for the next 10 years and then fall. The huge drop in projections is a result of the Federal Reserve manipulation of interest rates. The Fed is keeping 10-year rates especially low because mortgage rates are determined based upon this rate. As a result of the Fed manipulation, this forecast is not a fair projection of future rates. This is my snapshot of the change from Monday to Tuesday. This was actually the most change that we saw all week was during this 24-hour period. Starts to switch all the way up to this. Tuesday, the curve reached its lowest point of the period. The entire yield curve fell. The average change in interest rates was a decrease of 3.22% compared to the average of 2.31% for the whole week. The dramatic drop in rates can be explained by the market concerns surrounding the Cyprus bailout. On Monday, the Dow dropped 0.4%, the Standard & Poor's 500 index fell 0.6%, and the NASDAQ Composite Index dropped 0.4%. The markets were all down in response to this event. Investors wanted less volatile investments, increasing the supply of ownable funds in the bonds market. The 2-10 spread fell to 1.658% from 1.698% the previous day. That's a summary of the events from Monday to Tuesday, 2013. Tuesday to Wednesday wasn't quite as eventful as Monday to Tuesday, but rates actually rose this day. the entire yield curve lifted, and the average percentage increase in rates was 1.25%. On Wednesday, the Dow rose 0.4%. The Standard & Poor's 500 index rose 10.37 points. And the NASDAQ Composite Index rose 0.8%. Investor fears of the Cyprus crisis faded, encouraging them to put their money back into equity markets and decreasing the supply of vulnerable funds in the bond markets. The market is offering a higher return on these securities because of the decrease in supply. Following the Fed's largely unchanged policy, yields on the benchmark 10-year U.S. Treasury note rose 4 basis points to 1.595%. The yield had been as high as 1.98% earlier, but fell to around 1.93% after the Fed statement. So the rates were lifted by the decrease in supply. From Wednesday to Thursday, there was barely any change at all. Looking at the graph, it almost looks like there's just one line plotted here. There's a slight change in this area and a very slight change maybe down here. But for the most part, the rates didn't really change on this thing. The yield curve flattened from Wednesday to Thursday. The rates did not follow a uniform trend, meaning they didn't all move in the same direction. Rates on securities 9 years and further from maturity decreased, while those on securities 8 years and closer to maturity increased. Investors are putting more of their money into longer-term securities and less into shorter-term securities because they are expecting rates to drop. These future expectations of low rates can be explained by the Fed's announcement on Wednesday, March 20, 2013, that it will continue to pump money into the economy and keep rates low. The net effect on the yield curve was an average increase in rates of 0.68%. Yield on the benchmark 10-year U.S. Treasury note fell 3 basis points to 1.92%. So from Thursday to Friday, there was a little more activity. We can see the two lines split down here on the 10-year and a little further out. Rates on Treasury securities at all maturities decreased from Thursday to Friday. Feeling more optimistic about the Cyprus financial crisis, they put more of their money into the markets. On Friday, the Dow Jones Industrial Average rose 0.6%, the Standard & Poor's 500 Index closed up 0.7%, and the NASDAQ Composite Average closed up 0.7%. As part of their bond purchasing program, on Friday, March 22, 2013, the Fed bought $3.28 billion in debt maturing in 2018 and 2020, also contributing to the drop in yields. Yields on the benchmark 10-year U.S. Treasury note were flat at 1.92% this day. So in conclusion, the yield curve rates have dropped and the curve or wall has flattened for the week of March 28 to March 22, 2013. The Cyprus crisis sparked uncertainty in the market and pushed investors to put their money into U.S. Treasuries, which are believed to be a safe haven. The Fed announcement that it would continue to stimulate the economy by purchasing mortgage-backed securities and longer-term treasuries, it believes that though the economy is looking healthier, it could still use some help. Thank you.